Hey everyone. The market consistently moves by targeting liquidity. If you don't grasp how this mechanism functions, you'll likely end up being part of that liquidity. That's why understanding liquidity is absolutely crucial. In this video, we'll break down what liquidity truly means in technical analysis, why we highlight it on the chart, where the major liquidity zones develop, and how liquidity sweep setups unfold. Lastly, we'll look at how market makers structure their models around these zones so you can begin analyzing the market the way smart money operates. If that sounds valuable to you, don't forget to hit the like button to show your support and subscribe if you're new here. I'll catch you right after the intro and disclaimer. So, what exactly is liquidity? Picture owning a food truck full of burgers, but you're parked in a deserted area. You wouldn't sell much there, right? To make sales, you'd need to move to a crowded place where hungry customers are waiting. That busy location represents your liquidity zone. In financial markets, it works the same way. When smart money wants to sell an asset, they require a large pool of buyers. Therefore, the price first moves toward liquidity zones, and after sweeping those areas, it makes the major directional moves. That's the essence of how liquidity functions. In technical analysis, liquidity refers to regions on a chart where numerous pending orders and stop losses are clustered. Let's say this is our recent price movement. If the price retraces to this support level, many traders view it as a buying opportunity since it has previously acted as both support and resistance, forming a strong structural zone that could drive the price upward. However, smart money interprets this differently, as a chance to collect liquidity. If they plan to buy the asset, they need available sellers in the market, in other words, liquidity. When retail traders enter at this point, they often set their stop losses just below the level. Smart money targets those stops to gather liquidity and execute their own buying orders. In another scenario, suppose smart money intends to sell this pair. To do that, they must find liquidity to fill their large positions. So, where is that liquidity located? It's found where retail traders take entries. Here, we see a resistance area that has rejected the price several times. If the price revisits this level, many traders will go short, placing stop losses right above it. That means liquidity rests above this zone. To capture those stops, smart money pushes the price higher to trigger them and fill their sell orders. Additionally, when the price breaks above this resistance, many breakout traders will buy, anticipating continued bullish movement. Their buy orders also create the liquidity smart money seeks. Once the required liquidity is collected, the price declines, trapping retail traders on both sides of the market. Now that we've covered the core concept of liquidity, the next question is, why should we highlight these zones on the chart? Let's explore the main reasons. Number 1. Identifying potential price targets. The market naturally gravitates toward liquidity zones since they provide the fuel for upcoming moves. That's why we mark these areas as targets for our trades. For instance, if there's a major liquidity pool sitting below the current price, the market may dip down to capture that liquidity. By marking such zones, we can anticipate the likely direction of price instead of making random guesses. Number 2. Avoiding traps. We know that manipulation commonly takes place around liquidity levels. By understanding where these zones exist, you can align yourself with the right side of the market and avoid getting caught in deceptive price movements. Number 3. Creating higher probability trade setups. Once you identify where liquidity is positioned, you can structure your entries, exits, and stop losses more effectively. For example, you might wait for the price to sweep a liquidity area and then trade in the direction of the next impulsive move. This approach increases your success rate compared to entering trades blindly without market context. Now that we've discussed what liquidity is, how it functions, and why we mark it on the chart, let's go over the key liquidity levels you should focus on. There are several significant liquidity zones to highlight, but let's start with the main ones: swing highs and swing lows. So, what exactly are swing highs and swing lows? Swings represent turning points in price action where a specific candle formation appears. A swing high occurs when a candle forms a high, and the candles before and after it create lower highs compared to the middle candle. In contrast, a swing low forms when a candle makes a low, while the candles on either side have higher lows than the center one. These are often referred to as pivot points. Keep in mind, you can also apply a 5-candle pivot pattern for a more dependable reference point. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this October 18th. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500, plus 61% off for pre-bookings before October 18th. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. In this example, these are our visible swing highs and lows, which we mark as liquidity levels on the chart. The reason is that these points represent areas of market structure where traders have previously entered positions. When the price revisits these levels, there's a high probability that traders will place new orders again. As a result, liquidity builds around these areas, creating potential zones for manipulation. So, we highlight swing highs and lows as liquidity zones, but only if they remain unmitigated. Let's eliminate the swings that the price has already breached. Once we remove those, we're left with active liquidity levels, the ones that still hold significance. These are the areas where the market is most likely to return to collect pending orders. It's important to note that in an uptrend, liquidity sitting below swing lows carries more weight than liquidity above swing highs. This happens because, during pullbacks, smart money typically targets those swing lows to capture sell-side liquidity before driving the price upward again. These areas act as strong support zones where stop losses and pending sell orders are concentrated, providing the momentum needed for the next bullish move. Likewise, in a downtrend, the liquidity above swing highs becomes more relevant. The market often sweeps these levels to capture buy-side liquidity before resuming the downward trend. The next key liquidity formations are equal highs and equal lows. As the name implies, equal lows form when the price prints multiple lows at nearly the same level, while equal highs occur when the price forms highs at a similar level. But what does this indicate in terms of price movement? Equal lows on the chart often serve as strong zones for potential trade setups. Many retail traders expect the price to bounce upward when it retests this level, so they open long positions and place their stop losses just beneath it. This means liquidity accumulates below the equal lows, and in the same way, liquidity exists above the equal highs. The distinction between equal highs, lows and swing points is that far more traders pay attention to equal levels. Because of this, a greater volume of orders tends to cluster around them, resulting in larger liquidity pools. Number 3. Turning points. Turning points are price areas on the chart where the market shifts direction after following a sustained trend. Traders often interpret these zones as overbought or oversold regions. When the price revisits them, it typically triggers a strong reaction. These spots attract significant liquidity since both retail participants and institutional traders pay close attention to them. Number 4. Daily highs and lows. Daily highs and lows are crucial reference points for liquidity on any chart. The daily high marks the peak price reached during the session, while the daily low represents the lowest point. These levels draw a lot of trader interest, as many place stop loss or pending orders around them, making these areas dense with liquidity. Here's a common trading scenario. During the Asian session, price movement often remains within a narrow range, creating clearly defined boundaries. Liquidity accumulates just above and below that range. When the London session begins, the market often pushes past either the Asian high or the Asian low to collect that liquidity. After this sweep, the price frequently reverses and establishes its main directional move for the day. To trade this setup, you can wait for the liquidity grab to occur first, then look for a reversal entry in the opposite direction, which often aligns with the true market move of the session. Now that we've discussed the key liquidity levels, it's time to understand what happens around them and how a liquidity grab pattern actually works. A bullish liquidity grab pattern takes place when the price wicks below a liquidity level, or even closes slightly beneath it, before quickly snapping back into the range. So, what does this indicate in terms of price behavior? It shows that the market reached below support to capture liquidity by triggering stop losses and trapping breakout sellers. This action often signals that the market is preparing to move in the opposite direction of the liquidity sweep. For example, if price runs above the Asian high during the London Open but quickly falls back below that level, it indicates that buyers have been trapped. This gives traders a potential short opportunity, anticipating a move lower. The same principle applies to a bearish liquidity grab pattern. A bearish liquidity grab occurs when the price pushes above a significant liquidity level, activates stop losses and buy orders, and then swiftly reverses to close back below. This suggests that buyers have been trapped, and selling pressure has taken control, often leading to a downward continuation. For instance, in a clear downtrend, once the market gathers enough liquidity, the next bearish impulse is likely to unfold, creating an opportunity for short positions. When a liquidity grab pattern forms near a resistance level, it can serve as a powerful signal that the market may soon turn downward. Now, the liquidity grab itself serves as an early indication of reversal, but to make it more dependable, you can combine it with a change of character, CHO. So, let's go over how a valid liquidity grab combined with a true reversal setup looks on the chart. Imagine that the lowest point of this area represents where liquidity is located. In a valid liquidity sweep setup, we want to see a wick push through this level and then immediately close back above the range. Alternatively, we might see a single candle close below this line, followed by the next candle swiftly closing back within the range. This serves as an early indication that a temporary reversal may occur, at least up to the nearby supply zone ahead of the price. If the price manages to break and close above the most recent supply area, that would signal a change of character, confirming that the downtrend has ended and a genuine reversal is beginning. Combining the change of character concept with the liquidity sweep pattern gives us a highly accurate view of potential future price movements. Now that we understand liquidity levels and liquidity grab patterns, let's go a step further and discuss buy-side and sell-side liquidity, and how market makers engineer liquidity. The liquidity resting above a high or a cluster of highs is referred to as buy-side liquidity, while the liquidity below a low or group of lows is known as sell-side liquidity. Here's the key principle: the market constantly moves from one liquidity pool to another. After sweeping sell-side liquidity, price typically shifts its focus toward buy-side liquidity. Once the stops below the lows are triggered and that liquidity is collected, the market often reverses direction and travels upward to capture the liquidity resting above the highs. However, there are times when the price consolidates within a range, forming liquidity on both sides. Once liquidity is taken from one end of the range, the market often transitions to the opposite side to continue the ongoing cycle. This idea forms the foundation of what's known as the market maker model. According to this model, smart money orchestrates different market phases to create and exploit liquidity. First, they accumulate positions within a range, then push price in one direction to capture liquidity, and finally reverse it in the opposite direction toward the true intended move. The key takeaway is that liquidity pools, both buy-side and sell-side, act like magnets for price. You need to identify where these pools are because price typically gravitates toward them. If the price is trending upward, it's likely to target the next buy-side liquidity zone above. If it's moving downward, it's likely aiming for the next sell-side liquidity below. We use these liquidity levels as trade targets, entering positions before price reaches them and planning exits near where the next buy-side or sell-side liquidity resides. So, that's all for this video, guys. Thank you for watching, and I'll see you in the next one. I hope you found this video helpful. If you did, make sure to drop a like and subscribe to the channel if you're new here. Also, share your thoughts or questions in the comments below. I'd love to hear from you. See you in the next video.